Two of the largest bank failures in history happened this week. But before we talk about why, I have a question. Why is Jim Cramer so good at being so bad at his job? Just months before they both collapsed, he said this.
These are never, ever talked about. Why? Because they're too boring? I like to make money. Boring is good. Watch out for Signature Bank. That's my fave. SVB Financial, don't you want? This company's a merchant bank with a deposit base that Wall Street has been mistakenly concerned about. This morning, we witnessed the second largest bank failure in American history, which naturally created a wave of fear as the day went on. Hence, the Dow ultimately losing 345 points, S&P falling 1.45%, and the Nasdaq tumbling 1.76%.
Now, I have to admit, he has a way with sound effects. Now I understand why they call it mad money. But there is one thing Jim Cramer isn't wrong about, which I know is shocking. Fear is in the air, and many are worrying, is my bank safe? So today I thought we'd break it all down, the recent collapses, why the government has announced a special bailout, why some people are happy with it and others are mad, and of course, what's next. Let's start with the facts. Three major banks in the United States have failed in a short period of time: Silvergate, Signature Bank, and Silicon Valley Bank. Now, Silvergate was the smallest with about $11 billion in assets. Signature was like the mid-sized one, and Silicon Valley Bank was the largest. Now, Silvergate and Signature Bank were well known in the crypto space, while Silicon Valley Bank was massive in the tech startup world. However, despite their differences, these banks failed for similar reasons at a high level, which is this. They all experienced a run on the banks when too many people demand too much money too fast, and the banks don't have cash on hand. Now, I want to make something clear. It would be easy to draw the comparison to the crypto crash in 2022 when several crypto companies like FTX collapsed, but there's an important difference. Companies like FTX were insolvent. When there was a run on their banks, they had no money to give. Whereas the banks we're talking about were illiquid, meaning they had the money, but when they had the bank run, some of it was locked up in long-term assets like bonds. Now, to be clear, these are not the same things at all. But things can get a little fuzzy in the details. For example, when a bank run happens, what can start as a liquidity problem can become an insolvency problem if the bank has to sell what they have for cash. And let me explain. One of the safest investments is considered to be treasury bonds. Your grandparents probably invest in it. Banks invest in them, both for the same reason. They provide a stable rate of return. So say you're Signature Bank, right? You've got billions of dollars in customer assets. Where do you put it? Well, into treasury bonds, which let's say earn you 1% a year. You keep some cash on hand for withdrawals, but you figure, look, if I need to sell these, I can sell my bonds, right? But what happens if interest rates rise really quickly? Well, suddenly you have this 5-year bond you bought a year ago, which gives you 1% a year. But now the government is selling the same 5-year bond and offering 5%. Because of that, now your bond's value on the open market drops. It's no longer even worth what you paid for it because it's giving less interest than other bonds. And so if you try to sell that, well, now you lose money. Now, to be clear, if you held the bond to maturity, well, you would still make that 1% and not lose anything. But when depositors are asking for cash, it's simply not an option to hold on. Now, I know that seems complicated, but the essence of it is this. Banks were forced to sell long-term assets that they didn't want to sell, like bonds, and they took losses because of these bank runs. Because of that, what started as a liquidity crisis became an insolvency crisis, and that's why they got shut down, because they weren't going to be able to service all those withdrawals. So now what, right? Doesn't the government guarantee bank deposits? Why are we even talking about this? Well, they kind of do. The FDIC insures up to $250,000 per account. However, at places like Silicon Valley Bank, they had a lot of accounts with a lot more than that. Because as we spoke of, they hosted a lot of venture capital startups that might have had anywhere from $10 to $50 million in there. And suddenly, that company, which was healthy yesterday, now can't get access to that money and can't meet payroll because their bank had failed. And this triggered a huge response from many in Silicon Valley to call for depositors to have their money guaranteed, with people like Jason Calacanis saying, "You should be absolutely terrified right now. That is the proper reaction to a bank run and contagion. Guarantee all deposits up to $10 million or this will spiral into chaos." And comments like this sparked a huge debate on whether the government should or would get involved. Ultimately, with the answer coming on Sunday when the US Treasury said this, quote, "Depositors will have access to all of their money." And there you have it. The US government is stepping in to save not only Silicon Valley Bank, but also Signature Bank as well. They did this citing a systemic risk exception, which really boils down to a single idea. Please don't panic, guys. Please don't take out your money. Ultimately, the US government doesn't want you worried about your bank deposits. However, not everyone saw this as a win. Many were quick to point out that once again, the government only seems to step in to help a certain type of person. Quote, "Mark Cuban, bail out Silicon Valley Bank tonight. Feds, approved. Goldman Sachs needs $824 billion. Approved. JP Morgan Chase needs $416 billion. Approved. Average Joe, my wife has cancer. Can we get Medicare? We're broke." Now, I do have to tell you that those in favor of the Fed's actions will tell you that this is an unfair characterization, that it's not the super rich getting bailed out. They'll point out that this isn't a traditional bailout at all because it only applies to the depositors and that executives and shareholders will get nothing. And that sounds good, except for the fact that some executives and shareholders in Silicon Valley Bank had already cashed out, with Greg Becker, the CEO, selling $3.6 million worth of his shares right before their collapse. And this gets even worse when you consider that Greg Becker was one of the people who lobbied to deregulate his own bank. According to Heather Landy of Quartz, quote, "The ability of these banks to fly under the radar in the US was no accident. Greg Becker, SVB's CEO, lobbied U.S. officials several years ago to raise the asset threshold at which banks would be considered systemically important." So let's get this straight. They faced less regulatory scrutiny because they weren't systemically important, according to them, but when everything goes wrong, they're systemically risky and must be bailed out. It's a classic case of wanting it both ways. Now, again, this isn't the same as the full bailouts we saw in 2008. And regardless of whether you land on whether there should have been or should not have been a bailout, the idea that systemically risky banks should get special treatment and regular banks, I guess, don't, sends a pretty clear signal. If you're rich, you should move your money into banks that are too big to fail. Otherwise, you run a systemic risk of ending up on Jim Cramer, feeling like this.